Did you know that many millionaires effectively pay a lower percentage of their income in taxes than the average American? It sounds impossible, even unfair, but it's completely legal and rooted in specific sections of the U.S. tax code. We're not talking about shady offshore accounts or complex shell corporations. We're talking about smart, strategic moves available to anyone who knows how to use them. The average American might pay 20 to 30% of their income, while a savvy millionaire could be paying closer to 10 to 15% on qualified dividends and long-term capital gains. This isn't about avoiding taxes entirely, but minimizing them through legal optimization. The secret lies in understanding how wealth is generated and taxed differently than ordinary income. But what exactly are these powerful strategies that allow such a significant disparity, and how can you start applying them? The cornerstone of millionaire tax strategy is often long-term capital gains. When you buy a stock, a property, or any asset and hold it for more than 1 year before selling, any profit you make is taxed at a much lower rate than your regular income. For most individuals, the long-term capital gains tax rate is 0%, 15%, or 20%, depending on your income bracket. Compare that to ordinary income tax rates, which can reach 37%. Imagine selling an investment for a $100,000 profit. If that's ordinary income, you might pay $25,000 to $30,000 in taxes. But if it's a long-term capital gain, that same $100,000 profit could cost you as little as $0 or $15,000. The key here is patience, holding assets for over 1 year. But what if your investments lose money? This leads us to another powerful strategy: tax loss harvesting. When an investment performs poorly, you can sell it for a loss and use that loss to offset other capital gains. For example, if you have a $10,000 capital gain from selling a winning stock, but also a $3,000 loss from another stock, you only pay taxes on the net $7,000 gain. Even better, if your capital losses exceed your capital gains, you can use up to $3,000 of those losses to reduce your ordinary taxable income each year. Any remaining losses can be carried forward indefinitely to offset future gains. This means you can turn a market dip into a tax advantage, reducing your current and future tax bills. It's a proactive way to manage your portfolio's performance against your tax liability, but there's a specific rule you must avoid. Here's where many beginners make a costly mistake: the wash sale rule. To prevent people from selling an investment just to claim a loss and then immediately buying it back, the IRS has a strict rule. If you sell an investment for a loss and then buy substantially identical stock or securities within 30 days before or after the sale date, that loss is disallowed for tax purposes. This means your tax loss harvesting strategy could be completely negated, costing you potential deductions. You effectively lose the benefit of the loss without actually getting rid of the underlying investment for a sufficient period. Understanding this 61-day window, 30 days before the sale date and 30 days after, is critical for effective tax loss harvesting. But what about assets that depreciate over time? Real estate is a favorite asset among millionaires, not just for appreciation, but for a unique tax benefit called depreciation. The IRS allows real estate investors to deduct a portion of the property's value each year as a business expense, assuming it's a rental property, even if the property is actually increasing in market value. For example, if you own a rental property valued at $300,000, excluding land value, you can typically deduct about 3.63% of that value annually over 27.5 years. That's over $10,000 in paper losses each year that can offset rental income or even other income, reducing your taxable income without any actual cash outflow. This creates a powerful tax shield, but there's a common misconception about how it works when you sell. The common myth about real estate depreciation is that it's free money that never gets taxed. While you enjoy the tax benefits year after year, the IRS eventually wants its share when you sell the property. This is called depreciation recapture. When you sell a property for more than its depreciated value, its original cost minus all the depreciation you claimed, the accumulated depreciation is taxed as ordinary income up to a maximum rate of 25%. So, if you claim $50,000 in depreciation over several years, that $50,000 will be taxed at the recapture rate when you sell, even if your overall gain is a long-term capital gain. However, millionaires often delay this recapture indefinitely. But how? This is where the 1031 exchange comes in, allowing investors to defer capital gains and depreciation recapture taxes indefinitely. Instead of selling a property and paying taxes, you can use the proceeds to buy a like-kind investment property within specific timelines. For instance, if you sell a rental property for a $200,000 profit and then immediately invest that into another rental property, you can defer paying taxes on that $200,000 gain. This strategy allows millionaires to continuously roll over their profits into larger, more valuable properties, compounding their wealth without tax erosion. The taxes are only paid when the final property in the chain is sold without a subsequent exchange, or if it's passed down through an estate. But what about retirement accounts? Millionaires also maximize tax-advantaged retirement accounts beyond just 401ks. While a traditional 401k defers taxes until retirement, and a Roth 401k offers tax-free growth, there are others. For self-employed individuals, a solo 401k allows significantly higher contributions, up to $69,000 in 2024, compared to a standard 401k. This can drastically reduce current taxable income. Health savings accounts, HSAs, are another triple tax-advantaged gem. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. If you don't use the money for medical expenses, it acts like a supercharged IRA in retirement. These accounts compound wealth without immediate tax drag. But there's another strategy for current income. Strategic timing of income and deductions is a subtle yet powerful tool. If you anticipate being in a lower tax bracket next year, e.g., due to retirement or a career change, you might defer income from this year into next year. Conversely, if you expect a higher income next year, you might accelerate deductions into the current year or accelerate income into the current year if you expect a lower bracket now. For instance, if you're a small business owner, you could delay invoicing clients until January 1st to shift income to the next tax year. This proactive approach ensures you maximize tax breaks when they're most beneficial, effectively lowering your overall lifetime tax burden. However, what if you want to give money away? Millionaires often use charitable giving to reduce their tax liability while supporting causes they care about. Instead of donating cash, they frequently donate appreciated stock or other appreciated assets they've held for over a year. If you donate stock worth $10,000 that you originally bought for $1,000, you get a tax deduction for the full $10,000 market value, and you completely avoid paying capital gains tax on the $9,000 appreciation. If you had sold the stock first, you'd pay capital gains tax, reducing the amount you could donate or the after-tax value. This strategy allows you to give more effectively and reduce your taxable income simultaneously. But what if you have a business? For millionaires who own businesses, the legal deductions can be extensive, from home office expenses and business travel to equipment purchases and employee benefits. Nearly every legitimate business expense reduces taxable income. Even certain personal expenses can become business deductions if structured correctly. For example, if you use a portion of your home exclusively for business, you could deduct a percentage of your mortgage interest, utilities, and even home insurance. This isn't about fabricating expenses, but meticulously tracking and claiming every eligible deduction allowed by the IRS for operating a business. The line between personal and business can sometimes feel blurry, but careful record keeping is crucial to avoid issues. Yet, there's one critical mistake to avoid. The biggest mistake costing average Americans hundreds of thousands of dollars is simply not planning. Many people only think about taxes once a year, right before April 15th, and miss out on proactive strategies that must be implemented throughout the year. They fail to understand how their investments, their career choices, and even their charitable giving can profoundly impact their tax bill. For example, not understanding long-term capital gains could mean selling an investment a few days too early and paying 20% more in taxes than necessary. Or not utilizing an HSA could mean missing out on thousands in tax-free savings. Millionaires view tax planning as an ongoing financial strategy, not an annual chore, which leads to substantial savings over decades. This proactive approach is the real secret. But how do you start integrating these strategies? The key takeaway is that millionaires pay less tax by leveraging legal strategies embedded in the tax code, primarily focusing on long-term investing, real estate, and strategic timing. These aren't loopholes, but smart applications of the rules. Start by understanding your current tax situation and identifying which of these strategies apply to you. If you're wondering how these strategies might specifically impact your retirement savings in different types of accounts, check out our video on Roth versus traditional 401k. That's next. And for more insights into building wealth and mastering your finances, make sure to subscribe to the channel.